You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Buck has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Buck.
Hey guys, Kevin Buck here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Our guest for this week's show is real estate investment expert Daniel Alexander. Daniel is responsible for multifamily acquisitions, branding, and construction management at AH Capital. He directly supervises the firm's multifamily investments and negotiates all acquisitions for the firm. Additionally, Daniel oversees construction management and branding at Sycamore Property Management, AH Capital's property management subsidiary. Prior to co-founding AH Capital back in 2009, he successfully repositioned more than $100 million in residential and commercial assets in Southern California, Illinois, and Arizona. He also developed $15 million in luxury condominium and Class A medical space. Daniel holds a Bachelor of Arts degree in Business Economics from UCLA. And so, guys, in today's show, I'm going to dive deep into Daniel's value-add business model and really get a better understanding of what sets he and his team at AH apart from everyone else in this space. And so I'm very excited to get onto the show with Daniel. Daniel, how you doing today, my friend?
I am doing great. How are you doing today, Kevin?
Oh, doing awesome, man. Doing awesome. Just another day in paradise. So
yeah.
Give our listeners a sense of geography. I know that you guys are based in Atlanta, but you're not calling us from Atlanta today. You're where, man?
I am calling from the beautiful town of Austin, Texas.
Okay. Yeah. Very cool. So they're looking at property, I'm guessing, or
a little bit of both.
Okay.
Austin, Texas is a place that my wife and I like to spend a lot of downtime. So it's a lovely little place that we like to come to. And there are quite a few opportunities here. This market is very interesting to us.
Yeah, definitely a very dynamic market and a very growth-oriented market. So, no, that's very exciting. And so, Daniel, for those that are listening in that don't know about you, don't know about AH Capital or anything about your background, maybe take a few minutes. And obviously, I gave you a little bit of an introduction there, but I'm sure there's many different voids that I missed out on as far as your background and your experience. So take a few minutes and tell us a little bit more about yourself, if you would.
Wow. Okay. Well, my background, I mean, like many investors, I think they come from humble beginnings. Many of us, I do. I come from very humble beginnings. I was born in Los Angeles, California, single parent household, kind of moved around the city a lot and spent a fair bit of time in and out of several apartment communities as a youth. So got to know it from that side. Got into athletics when I was in college and I ended up graduating from UCLA and launching my real estate career at that point. I was fortunate enough to kind of get taken under the wing of a mentor who funded a lot of my early deals, which was great. We made a little bit of a deal. He said, "Hey, if you find something, I'll fund it, and we can split the proceeds 60-40." Within a couple of weeks, within a couple of weeks, I think I found about 11 or 12 opportunities.
Yeah, you took advantage of the opportunity, right? I like it.
A little bit.
Yeah, you got to strike when the iron's hot, man.
Yeah, and so this was early 1996, 97, 96 and early 97 when all this was going on. And I continued buying houses with that individual for about 8 years. And it was great. Together we did nearly 200 homes together. And things were kind of fast and furious. I went out on my own soon after that experience with them and started buying smaller apartment buildings, somewhere between 5 to 10 unit buildings. Nothing like the stuff that we do today. Mm-hmm. Really enjoyed that. I really felt like I was making an impact in the community. I noticed that there was a need for workforce housing. Mm-hmm. It just seemed like there was an endless need for workforce housing. And so I really decided to grow that skill in locating good quality workforce housing and transforming it in ways that people really enjoy living there. So I did that. Then roughly around 2007, I started buying larger communities, moving out of state, moved our operations, so to speak, into Arizona and Chicago. That worked out really well. Things were going well. And suddenly around 2007, 2008,
boom.
there you go. Cute. We know what happened there.
Yeah.
That was a true test for us. We had lots of projects in different phases, and we had to figure out what we wanted to do fast. Fortunately, we managed to move all of our projects along our business plan and execute our business plan. Now, I can't say the business plans ended the way that we expected before then, but we got them done. And so what I did notice, though, that there were quite a few projects out on the market that were basically just left unfunded. And I thought that this would be a good time to go out and start a new fund and take advantage of what was happening in the market. And we did that. Age Capital was born at that time.
Okay.
Yeah.
So give us a better idea and offer some clarity, insight on what type of projects you were really involved in when the market, took a turn for the worse. I mean, Illinois, I think the entire U.S. obviously got impacted, but some states and some markets much harder than others. Arizona, Phoenix market and some of the other big metros there are ground zero, just like they were here in Florida, and same with Nevada, Las Vegas area. But in any event, give us an idea of what types of projects you were actively involved in and how you managed to move through them unscathed.
I like the term unscathed. We were a little scathed,
but you had some bruises.
A couple nicks and bruises, but we made it through. So I'll give you 3 projects, one in each state. That'll probably help you a little bit. So in Chicago, I was doing condo conversions, buying smaller apartment buildings and converting them into condos. That we basically to kind of get through that without being unscathed, we just sold the apartment buildings as is, and we didn't do the conversions during the crash. So that helped us get through. And these were choices that, we get back into the office and you just kind of run the numbers and see what's your safest route for you and your investors and everybody involved. And for us, that was the safest route. Just get the rents up as best we could, get the places operating optimally, and sell them. And so we did that. Okay. Back in Arizona, those projects weren't really phased, surprisingly enough. We bought, our basis was very low. We had a great tenant population, and those things were just humming along. So there was no urgency there. Yeah, oddly enough.
I'm surprised at the apartments that you bought for condo conversions. I recall, many distressed, plays like that here in Florida where, a lot of buyers, you could essentially overpay price per unit if your exit was to convert into a condo and sell. And so a lot of folks, they didn't have that low basis entry point like you had, and ultimately were stuck holding the bag, and they couldn't convert these things and sell them off individually. So good for you guys that you got in at the right price and could ultimately walk away with just some bumps and bruises and nothing that a couple Band-Aids couldn't put back together.
And well said. One of the core principles that I learned in buying real estate is, you make all your money on the buy. If you can get your basis right, you can weather many things that you just are unforeseen. Mm-hmm. And that's kind of been a hallmark of the way we buy. We buy right.
Yeah, let's talk about that a little bit because where we're at in today's day and age, every market's local to itself, and so we can't just speak about the real estate market as an overarching theme as a nation here. But we can talk about it in generalities and still have a good discussion. So I want to talk about kind of what you guys do. I want to get a better understanding of what you guys do to put those risk controls in place. And so one of the things that we do as a company is we've got like an internal a stress test that we put each one of our opportunities through when we underwrite them. If we get far enough along to where it looks like we're going to actually tie something up, we run it through many different scenarios based on the particular type of deal that it is and what kind of debt it's going to qualify for today. And ultimately, what does plan A and plan B of our business plan look like? Plan A first, and obviously if plan A doesn't work, what's plan B? Right. Also factoring in, assuming, let's say it's a value add and it's got some shorter term debt on it. What if it's only got 5-year, what if it's got a 5-year note or balloon in place and we've got to refi? What are the capital markets going to look like? If our intent was to hold it long-term, but yet, year 4 or 5 come and rates have gone up, 2% or so, what do we do? How does that property operate? Can we still service our debt? Can we still pay our investors? Are we still in what we feel is a safe position? And so tell me what you guys do a little bit as far as on your side is mitigating your risk on the front end and still buying right. And what I find to be is a very aggressive nationwide marketplace for multifamily. We can talk about, specific markets, but generally speaking, it's aggressive all across the country. I just got back from a conference this past weekend and I was talking to a couple of value add guys that buy larger complexes and some, really good markets, but they were, they're literally squeaking along, buying stuff at like 5.6, 5.7 caps, and having to raise a ton more equity just to make the deals even work. And they're not going to even think about participating in the promote for quite some time. And it's like, gosh, I mean, these things are so lean. Like, what's even in it for you guys to take on not just the risk, but just there's effort involved and management intensity and overseeing these assets. I mean, it's not just like you set it and forget it, and they're doing it really with the back end. Hopefully we can exit out of this thing in year 3 or 5, or at some point there'll be a payday for me. So anyway, I think that's risky in my mind. But then again, I've been through the downturn. I suffered with some big bruises, and so we're incredibly conservative on the front end of all of our investments. But tell me how you guys do it at AH Capital.
Well, thanks, Kevin. You mentioned a lot of what we do. I mean, our underwriting is quite rigorous. I think we have a unique set of skills that just came about naturally. I cut my teeth in Los Angeles buying hundreds of deals in emerging markets in workforce housing areas. Mm-hmm. I really understand what the clients in those areas want. I really understand how it feels to be cost burdened and be a renter, and I understand how to create a community that is very sticky. And so we utilize some of those instincts as a holistic approach to try to develop the type of community that is more than just an economic place to live for a family. Mm-hmm. It's more like a place that services more needs. Imagine across workforce housing, or let's call it class C and B apartments. The choices are very interesting. You have mom and pop operators. You have all the way up to institutional operators. Mm-hmm. And the product quality is very inconsistent at times. You got these early vintages. And so we tend to do is we tend to offer resources that are very community specific. And for some reason, it tends to develop a very sticky client, a client that appreciates the community that's developed around them. And they tend to want to stay longer. We tend to try to empower those communities. Secondly, again, those instincts of investing in these emerging markets, these mini markets within greater markets, we've found ways of identifying areas that are kind of in the path of growth. So we don't want to be too far ahead of the path of growth, but we find ways to buy or at least locate assets and try to acquire assets that are in the path of growth. And so I think in the combination of those two things, as they come to fruition, we really feel like it strengthens our chances of, obviously, in our basis is we tend to try to get in it at the best basis we can. But with those things coming together, it kind of buffers us against a lot of things that you would tend to find if your basis is too high, if you don't understand the markets, the micro markets around you and what those clients are really needing. That makes sense?
Yeah, no, absolutely. And I want to dig a little deeper without having you give away all your secret sauce, but I want to get an idea of what you mean by, the finding the path of growth, like not too far away, but far enough away to where you can get in at the right basis, even when we're in a very aggressive market, buying market across the country. So talk to me a little bit about that. Again, you don't have to give all the secret sauce away, but you got to give us a little bit to grab onto there.
I'll give you a little bit.
Okay.
I can say that traditionally I've noticed in my career that investors sometimes don't think they're being active unless they're buying. And to me, that's not true to what real estate investing is. That's more speculating. It's not kind of value investing. And so we are more of a value investor. But in terms of like path of growth, you see things going on today like qualified opportunity zones, which are things that I've been operating in for years before they were labeled officially. And so you see stuff like that. You see areas that are in just classic C markets, but the microeconomy around those assets are thriving, but they're not A assets. Mm-hmm. And so how do I identify those? What metrics are your group? And I'm just speaking in general terms. Our team has a way of identifying certain metrics that can see right to those C assets that to us are A assets in C areas, so to speak, not by vintage, but just by the strength of the microeconomy around that asset. And our goal would be to open up the potential of that asset and tie it into the economy around it.
Okay. Do you guys have someone on your team that's more of like a data analyst? I mean, that literally spends their time and their days on identifying these certain trends?
Yeah, I think everybody in our office is a factotum, basically, does just a little bit of everything.
Yeah, no, I get it.
But I can say that myself and my partner Yusuf, we started, we cut our teeth again in the streets of Los Angeles, buying and selling, single family houses. Mm-hmm. And it's just something that you develop. It's hard to teach. It's just something you have to go through the steps. You have to do the work. And so, you do a couple hundred transactions and you quickly start to see some patterns emerging. And our backgrounds are in economics. We're trained to look for trends and things like that. And so, you start to see patterns emerging.
Okay. And where are you guys at today in your multifamily side? I think you've got somewhere, 2,000, 2,500 or so units or doors under ownership management. Where are you guys at? Like how far out are you spread?
Yeah. So Capital, like you said, started in 2008, 2009 timeframe. We basically exhausted all the equity in that fund and started another fund. And so with Capital, we're selling out assets, and we've been doing that since 2015. And the two original founders, myself and Yusuf, started a new group called Real Estate Asset Partners. And that group has started acquiring even more units. So in the portfolio, there's still roughly about 2,000 units. And then in the new fund, there's another 1,500. And then there's several opportunities under contract.
Got it. And where are you guys buying today? I mean, is there a certain region of the U.S. that you're buying in?
Yeah, so we love the Southeast. We love the Southeast. And so our office is in Atlanta, Georgia. And we are primarily focused there, though we are actively looking for opportunities in Texas and in California, where we originally started our careers. We're doing that for several reasons. One, we want to take advantage of some of the trends that are happening right now, what I spoke about earlier, the qualified opportunity zones. We want to take advantage of some of that. And we believe that there's more strength across several markets. So we're looking at it that way. And but we're mainly focused in the Southeast, specifically Atlanta.
Speaking of California, I know you guys, you got a background there. You understand the marketplace. You spend a lot of time there. A lot of times when you speak to folks about California that aren't from California, even being an option for them to invest in, they immediately run for the hills. Whether it's the prices or it's the skewed tenant landlord laws, most of the time it's the tenant landlord laws that scare them away first, and then they realize that I wouldn't be able to buy there anyway because prices are just too high and I can't make my numbers work with a 4 cap, right? But so talk to me about how you guys, more so the tenant landlord side of things, being in the workforce housing, being in that, targeting that lower end demographic. How do you get comfortable with the skewed tenant landlord laws and knowing that it could ultimately take you, 6, 8, 9 months to get a tenant out if they stop paying the rent?
Yeah, there is no comfort, to be honest.
Okay, fair enough.
That environment. And that was largely the reason why we started scaling our business outside of California, because of the throughput. It's hard to turn a rent roll in Los Angeles, being honest. If you get in there and upgrade all the amenities and try to kind of go through the rent roll and get better quality services in there and other tenants coming through, it's tough. And so you got to really pick and choose your spots in Los Angeles. And since we've been there for a very long time, we know the areas to buy in. We specifically look for areas without rent control, though there is current legislation that's been shaking.
Well, yeah, it's not there yet, but is it coming? Right. I mean, it's just I feel like it's a matter of time before pretty much every market in California, and then ultimately New York, the same thing, and in multiple other states, where it's just inevitability that it's going to come at some point. So that scares me. That keeps me awake at night. And
well, it does. It keeps us awake, but it's also a humongous opportunity. Is kind of what we are fashioned around right now. We have a passion for providing cost-effective, affordable, quality living, in that sector specifically, because there is a shortage in supply.
Yeah.
And that's just the bottom line. And typically it's been taken care of through government initiatives, but it's just not enough. There's a huge need in that area. And so we're committed to supplying that.
Okay. Yeah, that's a good point. I want to switch gears a little bit if we could, Daniel, and I want to talk about the value that your early mentor played in your overall success. Where you find yourself today. And I myself, I got very, very lucky. I was introduced to real estate by accident, and ultimately it was by someone who became my immediate mentor and really taught me the ropes. And I really attribute everything I've done up to this point to him. That the 1 year that I met him and that I spent with him, that was my foundation. I mean, he literally gave me the tools and the resources that I needed to kind of start with and then grow from. And again, it meant everything to me. So I want to hear from you as far as not just the value. Obviously, we know that your mentor brought you value, but ultimately, what kind of advice would you give those that are listening that not even necessarily just getting started, but maybe they're even looking to make a shift? Maybe they own single family properties, but maybe they want to get over to the syndication side of things and start syndicating larger multifamily properties. It can be a scary transition for a lot of folks. And I suggest a lot of times that they go find someone else that's doing it, that's being successful. But guys like you, guys like me, and other folks in our circle are incredibly busy, right? So I like helping people. I love helping people, but there's only so much time in the day, right? And so talk to me a little bit about, the value you got from a mentor, but also what advice you'd give those listening in of if they're at that point where, they're in need of a mentor, how to go about finding one.
I mean, finding a mentor is I think, a must in this business.
Mm-hmm.
My thoughts on this have changed over the years. I used to be a strong advocate of just saying, go out and buy something. You can't lose. At the very least, you will learn something, in the process. And hey, you could make it big, So I would always say that. I still feel that way to a certain degree. I think you should go out and get started. But at the same time, I think what's wise, and if you want to have a long real estate investing career, not speculating, but really build wealth, I think you should be investing alongside people that know what they're doing. Mm-hmm. Trusted people that have a really good track record and know what they're doing. And so, that's where I stand with that today, really. Get started on your own, do something, get moving. I was voraciously eating up any information that I could find. My mentor, he taught me how to play golf. He taught me how to network with equity. Really, he taught me how to locate assets. He taught me how to create budgets. He taught me many things that would have taken me years to figure out myself.
Mm-hmm.
And so I really.
How did you bring value to him though? Because I think that's the part of the equation that is that is the most important, right? When someone's out there seeking a mentor, is again, that person, what kind of value can they bring to the table to the person that ultimately might become their mentor, right? Because again, most mentors that are helping folks, they're busy, right? They've only got a limited amount of time and they've got a business to run for the most part. And so what kind of value immediately, and let's just speak about the value that you brought to your mentor. Obviously, you guys got to know each other, but ultimately that relationship probably would have been cut really short if you wouldn't have done something for him, right? If you wouldn't have brought value to his life. So tell me what that was.
It sounds like you've met my mentor before.
I know how it goes, right? I mean, again, we're busy folks, and that we've got limited time in the day. And although we'd love to help the entire world, it's got to be a give and take, right? There's got to be value going both directions.
No, it's such an interesting question that you asked. But my mentor, going back to what we spoke about earlier in the discussion, I found between 8 to 12 deals in 2 weeks. He didn't tell me that was unusual. He just said, wow, Daniel, thanks. Great. Let's keep it moving. He never really told me that was unusual. until a couple months into this, he finally asked me, where'd you find all these deals? And how are you doing this? He said, you know what, Daniel, I gave that same offer to nearly everybody in my family who wanted to do real estate with me, and no one's ever done it. And so I guess I didn't know I was adding value at the beginning. I just thought I wanted to naturally because I wanted to learn. So I thought, well, here's what I'm going to bring to the table. I'm going to bring some opportunities, and and he'll teach me how to do these opportunities. And so,
I'd have loved to have been a fly on the wall when he's like hanging with his buddies, like a couple weeks into meeting you, and he's like hanging out with some of his buddies having a beer, and he's talking about this young hustler that just is bringing him like a slew of deals, and he's like kind of bragging about you, right? Because you didn't know, and he didn't let you know that, like, how much you were absolutely killing it. But I'm sure he talked about it behind the scenes, right? So that'd been interesting to hear.
Very good friends. He took me everywhere, and I could really tell he enjoyed that process. And so I would say, as you look for mentors, you should be thinking of what value you can bring. And in our company, we tend to break real estate down in really, really simple terms, and figure out what category are we going to bring value in, or what we're talking about. We break it down in deals, money, and information. Pretty simple. Yeah. You've got opportunities, and they can come in many different forms. That's a value. If you've got equity or debt or some kind of way to structure that, of course, that's a value. And then information. If you have some unique way to combine all of that, or sell real estate for a higher cost per square foot, or some unique idea, some way that can give you an edge, that's a value. And so you have to figure out which one of those places that you can add value in, and then focus there and try to do so.
Yeah, no, I love it. So I want to switch gears yet again. I want to talk about the property management side of your business, and I'm going to make a guess, a stab in the dark, not really, but that you guys self-manage based on the fact that you have a property management arm of your business. Is that a fact?
We do not self-manage anymore.
Okay, got it. That's even better then, because I want to find out why.
This is a lengthy story, but when we started buying in Atlanta, we bought roughly 2,500, 2,700 units in an 18-month time frame.
Wow.
And these were heavy value add. What I mean by that is, I take one particular community, is 500 units. And this community was, I think, roughly 50 or 60% occupied, but really actually it was physically 50 or 60%, but economically about 30.
Oh my, wow.
So think about that. And so trying to get a third-party management company who actually would try to buy into our business plan and not be afraid, we found to be tough. So you chuckle.
Yeah, there's not a lot of reward for the property management company for the amount of sheer work that a property like that takes to turn around.
Exactly. And so we just decided, hey, that's kind of what value add real estate is. It's not sexy. It's just, you do the job. There are things that you just got to get in there and do. And so that was one of the things that we needed to get in there and do. So we formed a property management company on top of all of that. So hiring all those employees, training them, and getting them to buy in and execute this business plan along with us. It worked brilliantly. No regrets. I firmly believe in self-managing. I think that it's wiser to do when you have more units to start with than building like that. But at the same time, some people do it the other way, and you can learn all the way up. And then when you do third party, all the ins and outs, and you know how to structure your budgets and your business plans and your contracts to align with the interests of the property. And so either way you go, I think you can find success.
So let's talk about that real quick. As far as building that property management company, so you guys bought, roughly 2,500 doors, 2,700 doors in 18 months. Obviously, your plan A going into this was to bring on third-party management to help with the execution of these heavy value-add turnarounds, and ultimately you had to go to plan B because you couldn't find any competent management companies to do that task. So you had to form your own. Which, don't make that sound so simple, because it's not. I mean, actually, you're building an entirely new company, and it's a business model that. It's not profitable enough. It's just by necessity, right? Like, you're not building it because it's going to absolutely kill it. It's out of necessity more than anything else. And so did you guys tell me about who you went out to bring onto the team? I mean, did you guys do it? Were one of the one of the principals of your group like really the operational role of that, or did you go out and find just an absolutely rock star operations person and bring them on the team to oversee that company?
Both. One of our partners is highly technical and detail oriented in terms of setting up operations, so that was a plus for us. But we did go out into the market and seek talented regional managers and basically property management president type individual, and hired them and build organizations underneath them, and empower them to go forth and kind of create our organization. And so we did that. And again, it was by necessity. It was by necessity.
Where I was going with that is you guys went out, you didn't skimp on the talent. I mean, like you went out and found, you didn't find the people that were the cheapest. You found the people that were the most talented. And I'm sure that it costs a good bit of money to get that talent in the door. But ultimately, it was the best move in the long run because they're essentially managing the operations and the turnaround of these properties, right? I see so many people that go down that road and they try to piecemeal together by hiring people for $10 an hour, $12 an hour, and they piecemeal together this really haphazard property management operation. Whereas, like you're just better off at that point in time, instead of being cheap about either give it to a third party manager or go out and really find the talented folks that can help you build that side of your business if you ultimately want to do it in-house. So,
we're a firm believer in finding people that have a passion or talented for doing what they do and empowering them to do that. And so in property management is one of those areas. So is design and development for us, another one of those areas. So is same thing with our philanthropic efforts. We want to find someone that is very passionate about that and allow them to, grow that part of our business. And we focus on growing the overall enterprise, bringing in great opportunities.
Okay. So I've got a two-pronged question I want to ask you now. Part A, part B, right? The first one is very short and sweet. What excites you the most about today's market? The part of the real estate cycle that we're in, and you can pick any one of the given markets that you guys are buying in. But just generally speaking, what excites you the most about where we're at today in the grand scheme of things? And then part B of that question is, what scares you the most? What keeps you up at night?
Okay. Well, interesting. Another good question. I guess what excites us is that at this time, I've been through a cycle before, down cycle. I've been through a run up and a down cycle before. And I noticed before the downturn and right at the run up, it was a time frame where the kind of men from the boys or the talent from just speculators was separated. Right now is a time that you'll really see who has staying power and who actually are real estate experts and who are just speculating, so to speak. So that's exciting. We feel like we have an advantage when it comes to that. In terms of what keeps us up at night, we're just excited, to be honest, because if you look at the numbers, we are still at an all-time high in terms of lack of supply of workforce housing. This is a problem that is discussed throughout our country.
Yeah.
Right. And I think over recent years, cost burden renters have even gone through to the top of Class A renters. It used to be something that a C or B class renter would experience. Now it's across all spectrums. And so what that means is that there's a humongous pain body in the housing supply called lack of affordable housing that the government cannot address. We believe we have a solution to severely inject affordable housing into the housing supply to augment that and provide quality affordable housing. So for us, there's no better time to do it than right now.
Okay. That keeps you up at night? That doesn't sound too scary to me.
It's exciting. That's why.
Okay. Good deal.
Hard to sleep when you're excited.
I'll accept that. That works. So you've been at this now for many years. It sounds like you and I have been at this probably for about the same period of time. I know, given the chance to go back in time and give myself in year one some advice, after knowing what I know today, I know what kind of advice I would give myself. I've got a ton of it. But I want to hear from you. If you can go back and give Daniel some advice back in year one after what you've been through and the experiences that you've had, what would that advice be?
Wow. Another great question, Kevin. A lot of times when I find myself reflecting my career, the one thing I could say that I would do different is think bigger, see the overall opportunity. Early in my career, I saw 2 or 3 or 15 houses as an amazing opportunity, to own 15 or 20 homes, or have bought and sold 15 or 20 or 30 or even 50. Then I started to understand that I was actually providing great living choices for people that didn't have those options. And so I said, wow, how could I affect 100? How could I positively affect 200, 2,000, 5,000, 100,000? And so now as I look back and I bring it forth to today, I just want to make sure that I completely understand the magnitude of what's needed and be prepared to take on that challenge. And so I would say to most people out there, think big, find out what your passion is, and figure out how you can do it in the biggest way possible.
Yeah, no, I love that. Absolutely. No, that's a fantastic answer. And something, I'm definitely aligned with that, and something additional, and I've got a lot of additional things I would add, but ultimately one of the big things for me is, and I probably didn't know what this really meant back when I was, 19 years old, getting started, as far as like what kind of life I want to live. Back then, I didn't know if I wanted kids or not. I had no idea what the future would hold, right? As far as family and, what type of lifestyle I was going to find myself in, like what would really, be attractive to me as far as just general life and where I wanted to live and things like that. Anyway, now looking back, I would say, really dig deep into that, as far as lifestyle design, and a lot of people, if you're only 19 or 20, you might not know the answer to that. I surely wouldn't have. But always keep that in the back of your mind, design your investment philosophy and goals around, on the selfish side of things would be yourself. Like, where do you want to go in life? Like, where do you want to live? Do you want to have flexibility? Do you want to, grow a large family and spend a lot of time with them and have more of a passive role in your business? Do you want to grow a huge company that employs thousands of people, ultimately impacting thousands of lives in a positive way? If so, really build, focus on how to get there, build your portfolio around that. But really, again, geared towards lifestyle design overall. And then additionally speaking is, would be the positive impact you can have on others. And you kind of touched on that already. We're in the manufactured housing space, and it sounds like we're very, very similar in that, like we don't look at our properties as just doors or units. And, we're really into providing affordable housing, a clean, safe, and quiet living environment for deserving families, folks that, we're in great markets with great schools. We want to basically have those families that want the best for their kids, but yet maybe the families only make, $30,000 or $40,000 a year of combined household income, right? They can't afford the stick-built home. They still have that American dream. They can't afford a stick-built home. They still want to send their kids to the best school, but they ultimately can't afford to live in the $400,000 neighborhood. So we want to provide a clean, safe, and quiet environment for them to live in. And so, like, there's real bodies attached to our investments. Like, there's people behind the scenes. And so we've even recently started some philanthropic charitable activities inside of our communities, which has been really, really cool, where we're, giving out backpacks to the children with school supplies and things like that. So, and it's very rewarding, and I think, again, when you're 18, 19, 20, if you're getting started at that age, you might not know exactly, what that means to you. And you might not have that bone in your body yet, but, you want to keep that in the back of your mind as you grow your business, and know that it's just not about the money, have some other type of purpose behind it. And so really, build a purpose-built business more than anything else. In any event, I want to switch on, Daniel, if we could, to what I call the golden nugget segment of our show. And this is where we're going to work on wrapping things up. But, you've shared a lot of golden nuggets here today. And what I'd like to ask of you is if you could think of just one last final golden nugget of advice or wisdom that you could leave with our listeners today that may inspire and motivate them as they progress in their real estate investing career. What would that one last final golden nugget be?
Oh, wow. I like a lot of what you just said. But I would say in a short sentence, work is play. Laugh, create, and help others. Just keeping it short and sweet. Laugh,
I like that.
And help others.
Got to have fun when you're doing it, right? If you don't, you can't just do it for the notoriety, right? You got to actually have a good time and enjoy the journey along the way. And that means so many different things for different people. And don't do it for the glamour of it, or just this, like you'd made a mention about, I forget what you exactly said, but you referenced success, or I think maybe success isn't necessarily just because you're buying activity. It's something along those lines. Like you're referencing those that are out there just buying just to buy, right? Like they think they're actually making progress just because they're buying units, but you got to buy things right. And so, just don't get caught up in that, and just be conscious of what's going on around you. But in any event, no, I think I love that, short and sweet, buddy. And those that want to learn more about you and your company and what you guys are up to here now, what's the best website to send them to? I know you got your hands in a bunch of different pots, and so I want to make sure that we direct them to the right area. Would that be ahcapital.com? Or I know you mentioned your new endeavor that you have. Is there a better website to send them to?
Absolutely. So our new endeavor is called Real Estate Asset Partners, and our URL is reap.capital. So that would be reap.capital.
Okay.
That's launching at the very end of this month. And there will be quite a bit of information about us, updated information. There'll be our entire track record will be there. You'll see information about investing alongside us in qualified opportunity zones. We're even doing co-living initiative, which I didn't touch too much on today.
Interesting. Okay.
For a reason I didn't touch on that. We can save that for later.
Do you actually have some projects in the works right now?
We absolutely do. Yes.
You do. We need to bring you back on and talk about those. That'd be an interesting topic.
I would love to come back and talk about that.
Yeah. That's fantastic.
So, that's where you find us.
Okay. Fantastic, guys. I'll make sure to put that in the show notes. And Dan, that's all we have for today, my friend. I really appreciate you coming to the show. It's been a lot of fun. And again, share that website one more time. It's REAP Capital, correct?
REAP.capital.
Capital. Okay, .capital. I didn't realize that. I didn't know that was an available, whatever URL. I didn't know that .capital was one of them.
Yeah, it is unique. It's an affirmation. Go out there and reap capital. Okay?
There, I love it, man. Daniel, it's been an absolute pleasure, my friend. You take care, and we'll talk again soon, okay?
Thanks for having me, Kevin. I'll talk to you soon.
All right.